So the small investor is someone who, very much like me, has no background in finance or trading or investing. Let's say maybe someone who doesn't have any access to computer languages to create trading bots. So very much a very manual trader who doesn't understand markets very well. Arbitrage is a relatively safe type of trading. What is arbitrage? Well, it's a fancy word for buying low in one place and selling high in another at relatively simultaneous times. I got into it because, well, I just needed the money and saw the prices going up and down. But there were special features about Bitcoin, like why didn't I get into day trading? It seemed like something I put on, it was on my list of things I wanted to do, like I should try to trade some currencies or stocks or something. That seems fun, and I wouldn't mind supplementing my academic income since they don't pay us professors very much. One of the special features, though, about Bitcoin trading and digital currency trading is the speed. So you don't really... Why does that matter? Well, normally you would, with an arbitrage opportunity where the price of some asset is at one place somewhere and then at another rate somewhere else, you would need assets at both places. So, for example, this higher. So you might need dollars at Cripsy, you would think, and Bitcoin at Bitfinex, so you can sell your Bitcoin, your one Bitcoin at Bitfinex for that higher price and buy it for a cheaper price at Cripsy. But the cool thing is that the speed affords this sort of diachronic arbitrage strategy, which perhaps is less common outside of this infrastructure. Diachronic as opposed to synchronic at the same time. Diachronic arbitrage, you buy it, you have dollars only, you have assets only in one location, say dollars at Cripsy, you buy your Bitcoin, send it really quickly to the other exchange, and then sell it there. Since it moves so quickly, it's roughly simultaneous, buying and selling, and you lock in your $5 profit per Bitcoin. So the speed affords that sort of strategizing, but it gets cooler because the counter currency, if it's another digital asset, can return back to that same original location just as quickly, including with fiat. So if you have some sort of representation of US dollars on the blockchain, Nick was talking about this, Chris Oden was talking about these types of things, where you can represent even conventional currencies on the blockchain. Then you can get your dollars back just as quickly. So for example, I've used Tether, it works. I don't know that much about the company, but I do know that they convert US dollars into USD tokens. The platform is built on the blockchain, and you can send US dollars from Bitfinex to Cripsy to Poloniex, any exchange that accepts it. So then what you get is this speed in both directions, which allows the small investor, someone who perhaps isn't trading that much money, to capture larger and larger amounts of arbitrage because they can recycle their small amount of capital. So maybe you only had one Bitcoin, maybe you only had $200 at Cripsy when Bitcoin was $200. You were only able to buy one Bitcoin, send it to Bitfinex, sell it, but that maybe there was 100 Bitcoins worth of arbitrage. So then send the dollars back, rebuy, send, sell, repeat. So the small investor does have this sort of special opportunity which, with the digital infrastructure, by recycling their principal. So that's one type of strategy that the speed and these diachronic structures allow for. You could do it potentially with any asset. was it Anthem who was talking about how they're creating a similar token type system on the blockchain for gold. Another type of infrastructure which facilitates this sort of trading, it's not built on the blockchain, but it's separate infrastructure, it's separate ledger style infrastructure, are these consensus algorithmic ledgers like Ripple or Stellar. Stellar is relaunching its technology on November 3rd. What they do is they add this other level of infrastructure in between the exchanges and gateways. So you could take assets from Bitstamp, say US dollars from Bitstamp, withdraw it to a digital token in your Ripple wallet, and trade that for any other digital token in the Ripple wallet. This allows you to make your own markets, and you can get as creative as you want. As long as there's a gateway from some exchange into a Ripple wallet or a Stellar wallet, you can trade any asset for any asset. So you could trade snap swap dollars for Bitstamp Bitcoin. You could trade Mexican pesos for Bitstamp Bitcoin. So a lot of what I was doing was finding arbitrage by creating my own markets. So for example, suppose you were studying the market between Dividend Rippler and Bitstamp. So Dividend Rippler is an anonymous gateway. There's no KYC protections there. They built a bridge. You basically send Bitcoin to, and you don't even log in. You send your Bitcoin to an address that's dedicated to your Bitcoin wallet. It automatically gets deposited into your Bitcoin wallet. So now you have Dividend Rippler Bitcoin. You can sell those for Bitstamp dollars. I used to set up that market because, well, there was a wide spread, and sometimes people would buy. But if you study it, you see that, can you see that? What we notice is that there's virtually no volume here. But then suddenly someone sells 40 Bitcoin here, 80 Bitcoin here, 60 Bitcoin there, and 40 Bitcoin there. This is the fall. This is November of 2013. You can see the price of Bitcoin is rising up through December. So somebody's selling large amounts of Bitcoin suddenly. And if you notice the pattern, it's every week. So every Wednesday, and then they skip a week, and then early the next week, and then early the following week. So if you're catching any of that, if you're noticing these patterns, you can be there when they arrive. And the other interesting thing, I don't know if this is actually visible. It looks a little dark from here. These white columns that I drew in here represent the actual price at Bitstamp. So the person is selling Dividend Rippler Bitcoin for $10 cheaper than you could sell them at Bitstamp. So what's the strategy when you notice this? Well, obviously, you send, and suppose you only have 10 Bitcoin. This is what, 220 Bitcoin over a 4-week period. You send your little measly amounts of Bitcoin to Bitstamp, sell it for dollars the normal way, withdraw it to your Ripple wallet, get the offer for the cheap Bitcoin, send it out through Dividend Rippler's bridge, straight back to Bitstamp, sell, repeat. Again, another example of recycling the principle using this extended infrastructure. So you started off with 10 Bitcoin, you deposited the USD. I just described the mechanics of that. But what's the upshot? The upshot is that you started with 10 Bitcoin. Let's say it was worth about $3,000. Let's say it was worth $3,000 at the time, right? You ultimately, with 10 Bitcoin, sold 230 Bitcoin for $149,000. You bought them back for $146,700 for a $2,300 profit. Relatively low risk, because, I mean, you sold it for one price while at virtually the same time buying it back at a cheaper price. The main risk here isn't like with directional trading where you buy $230 worth of Bitcoin and hope the price goes up. That kind of directional risk is a different kind of risk. Arbitrage is relatively safe. You don't have to know how to plot your stop losses, etc. The risk that you do have, of course, is infrastructural. You are trusting third parties here. You are trusting that while that arbitrage is waiting there for you in the Ripple wallet, that when you sell your Bitcoin at Bitstamp, you're going to be able to withdraw those tokens into the Ripple wallet fairly quickly before the arbitrage disappears. We all know that withdrawals can be held up at exchanges. Similarly, when you come back out, but that's not the risky part in this particular scenario. In this particular scenario, it's getting those dollars back into the Ripple wallet before the arbitrage disappears. So the kinds of things that go wrong is that, of course, you're trusting third parties to hold your assets. The exchange could go full Gox. That's happened to me at JustCoin. When JustCoin got robbed, I lost thousands of dollars worth of cryptocurrency. Exchanges have difficulty with their withdrawals. You could lose your arbitrage because things are held up. For example, at Cryptsy for days or weeks or months. Or worse, it's your own, you're usually your own worst enemy with arbitrage. You could be on a relatively thin order book, press the wrong button, and accidentally, do a market sell for 60 Bitcoin, and then you just ate through the order book and lost a lot of money. So if you're not careful, there's that. That's happened to me. I almost cried. I did cry. You can get scammed. I once sold $15 worth of Litecoin on eBay, and of course, it was a stolen credit card that the person used, and so I lost the asset and the payment. So some things that might help with, reduce some of that kind of risk would be less trust in third parties, but of course, you would need some sort of peer-to-peer order books that are definitely less centralized than we already have. I mean, even Ripple is centralized to some extent. I'm not sure. I think all the validators for the transactions are sort of run by the company, which is a for-profit company, Ripple. Stellar is no longer a fork of Ripple. The new code will be different. It's a different consensus algorithm that they're releasing in a few days. They're non-for-profit. Hopefully, the validation process will be less centralized. Exchanges and gateways. There are no decentralized gateways that I know of. There's always a third party running it. It's holding the asset. But it looks like, from what people have been saying throughout the conference, there are possibilities for completely decentralizing that as well. So here's another kind of strategy. I don't know what to call it. Skip the countercurrency altogether. Just make an offer to sell 0.98 Bitcoin for 1 Bitcoin. When I tell friends that I do this, they're like, wait, what do you mean? You just sell a fraction of a Bitcoin for a Bitcoin? Does anyone take that? Who would take that offer? Well, they do. Why? Because it saves them money. Well, how does that work? So this is going to be a case where I'm using this sort of Ripple-type infrastructure to trade, say, Bitstamp Bitcoin for Bitcoin to Ripple, which is, I think, owned by SnapSwap or a subsidiary of SnapSwap. So basically, SnapSwap Bitcoin for Bitstamp Bitcoin. How do you do that? Just put an order up, offer 0.98 Bitcoin for 1 Bitcoin of the other from the other gateway. This is from last week. Can you see it? It goes from June till last week. I think it's a 1-day chart, so each vertical is a 1 day of trading. And you can see here that we're trading Bitstamp Bitcoin for SnapSwap Bitcoin. And the price here, people are paying $1.05 or 1.05 Bitcoin for a single Bitcoin. Here they're paying 0.98 Bitcoin for 1 Bitcoin. So while I'm sitting here in this conference, Bitcoin aren't trading for Bitcoin. They're trading for less Bitcoin or more Bitcoin. And you set it up as a limit order, and there won't be very large, the more volatile the market is, the more this gets hit. Why? Why are people taking these offers, I guess is the question, right? But they're not taking them directly. There's a number of things that could be going on. One possibility, here's Bitstamp's hot wallet. You can keep an eye on this. This is the amount of Bitcoin that could be withdrawn into the Ripple wallet at this particular point in time. If somebody withdraws 208 Bitcoin into the Ripple wallet, their hot wallet goes empty. Sometimes it takes them hours, sometimes it takes them days to replenish that. There's a higher demand for Bitstamp Bitcoin. It doesn't even have to be a conscious demand. It could just be that the pathfinding algorithms are taking the buyer through my limit order of Bitcoin for Bitcoin because it saves them money. So we can see here that there's a discrepancy between the cost of ripples using SnapSwap Bitcoin versus Bitstamp Bitcoin. So there's a difference. If I wanted to suppose I'm down here and I want to sell my SnapSwap Bitcoin for 60,400 ripples, right? What if it's cheaper for me to buy the Bitstamp Bitcoin and then to get this better deal up here? Then the pathfinding algorithm will just give me that deal through that order of Bitcoin for Bitcoin. So it's saving me money. I was willing to just take this many ripples for my Bitcoin. I was going to sell a whole Bitcoin for it. Well, now I can go through Bitcoin for Bitcoin, get a better deal without even realizing it, and notice that I have more assets than I was willing to have at the end of the transaction. So the automatic pathfinding algorithms, which are indicative to a Stellar protocol or a Ripple protocol, just happen automatically in the background. So the market maker who just decided, you know what, I'm just going to sell Bitcoin for Bitcoin and see what happens, will just get their offers eaten up, especially when the market gets volatile. And, it's up to you to decide which market you want to make. Dollars for dollars, this became very popular, but at the end of 2013, there was hardly anyone offering dollars for dollars. But look at this. This was last week. Here, SnapSwap dollars, for 92 cents, you can get a whole Bitstamp dollar. A few days later, people are paying $1.04 or $1.05 for a Bitstamp dollar. But again, because the other bids and asks, the spread was because of the arbitrage happening across these order books. So here we see, suppose you had $1,000 and you wanted to buy ripples with that, you can get $1. You'd only get $1.09. You'd only get 190 ripples per Bitcoin. I'm sorry, per US dollar, backed up by SnapSwap. For $1,000, you would be getting this rate of 190 ripples per dollar. But look over here. You can get $1,000 worth for 216 ripples per dollar. But you can't get that because you have SnapSwap dollars. Well, then it's cheaper for you. So the pathfinding algorithm will just sell your dollars for Bitstamp dollars, then buy you ripples. So So it saves you money there. And meanwhile, the market maker who made that savings possible also made money. So everybody's happy. So that was the second strategy we talked about, skip the counter currency and just make direct offers, Bitcoin for Bitcoin, dollars for dollars, yen for yen, and make the trading smoother for everyone and cheaper. Whale watching is another thing that the new economy offers even the small investor, right? Maybe the guys on Wall Street know how to see how money's moving and what's about to happen, but us small investors don't have access to what they see. They know that there's about to be a big sale. We don't know that. They have the advantage. We don't. But in this particular economy, anyone can follow anybody. You can watch the accounts that have patterns of interesting trade behavior. So here's something that was happening in November of 2004. Right around here, there was suddenly large volumes of US dollars from SnapSwap buying ripples. And if you drill down and look at which accounts are doing that, right, you can order the accounts, and this is all manually done. There are websites doing this. You don't have to code any of this yourself. On Ripple charts, you can just go here and rank all the volume, by largest volume, find out who the whales are, get those addresses, plug them in, and you can get notifications whenever $50,000 shows up at that address. Give me an email. There's really cheap websites. So Elsdorfer is a developer who created this website. You can just plug in whatever address you want here, pay $1, and then indefinitely you'll get a notification every time there's a deposit into that account. So if you know there are only 5 Ripple addresses that are buying massive amounts of Ripples in this time period, $50,000 worth, $40,000 worth, $10,000 worth, then just get notifications about those addresses. Then you know the price of Ripple is about to go up. This is something everyone has access to now. But then what do you do with it? So one possibility is try to get some OTC, make some OTC connections. So there was a time when SnapSwap had on their website the possibility to buy large amounts of Ripple over the counter off the order books. Everyone could do it. So you get a notification from Elsdorfer that $50,000 just appeared in this one Ripple wallet. In the past, that person has bought large amounts of Ripple. Good. You know the price of Ripple's about to go up. Email SnapSwap, tell them how much Ripple you want, wait for the price to go up, then sell your Ripple. So the speed allows for the diachronic strategizing. The diachronic strategizing allows for recycling small amounts of principal, combined with other strategies like whale watching addresses that have patterns of interesting behavior. You can also just set up very safe limit orders, ignoring the counter currency. And, the limits are sort of defined by your own creativity. You can create your own markets and devise various other types of strategies as well. So one thing that most of us already agree with is that the conventional infrastructure is relatively slow. It's limited. We don't all have access to it. But the new economy is finding ways around it. And we can take advantage of that. And it's very exciting and it's empowering. Thank you.
Thank you very much, Dr. Joseph Salerno. Any questions for Joseph while we have him here for a minute? Will, come on up, please, or I'll come to you. We'll meet in the middle.
In your arbitrage adventures, did you ever explore any in the local Bitcoins ecosystem, and what, if so?
I never bought any Bitcoin on local Bitcoins. I like the idea of local Bitcoins. I like Craigslist. I sold a lot of things on Craigslist, and I thought that was empowering, that I could turn it back into cash, stuff that I didn't need anymore. Baby furniture has very, short lifespan. in one's household. It's really nice if you could sell it back into the community. It's so they don't have to go to IKEA to buy a new crib or whatever. But I never did buy any on local Bitcoin. I always hated those sorts of interactions in person. I really liked that I could be on a computer, spot something, arbitrage between Hong Kong and Florida, and then within a few minutes have assets in both places, and then before I go to bed have all the assets back home. Like, I don't want to meet people. It takes too long, and I don't know them. And what if then I sell them Bitcoin for $10,000, and then they know I have $10,000 in my pocket, and I live in St. Louis, where I'm probably going to get mugged anyway, even if I don't have the $10,000. So it's like, I don't want to do that.
You can do online trading with local Bitcoins, and there are some interesting spreads for gift cards and.
I noticed that the prices, there are those spreads, and the prices are really, they look like there's a lot of chance for opportunity. And I do encourage others to sell and buy that way.
Fantastic. Another question here, Brian.
Yeah, I'm curious, do you ever run into any legal risks in what you're doing? Any run-ins with the IRS or anything that you foresee, perhaps even in the future if you do not?
So as far as I know, as a private investor who's investing only for myself, I don't need any licenses. I don't need any FinCEN authorization or any of that. As far as taxes go, I gave every transaction that I could recover from for 2014 to my accountant in February, and on October 14th, he said, "Can you write some checks?" And I said, "It's about time." But I'm not worried about legal trouble. I'm worried about how do you do this accounting. I mean, Michael mentioned Libra tax earlier, and I'm going to look at that because even accountants aren't used to figuring these sorts of things out. If you're buying stocks and selling them, usually there's some broker who gives you the bottom line, and then the accountant just works that in one line on your tax page. Does it do first in, first out at? Okay. There are options, and the hardest part about trading with Ripple is my accountant figured, well, okay, so we want to do first in, first out at each exchange. So, you bought Bitcoin at Bitstamp, and then 3 months later you sold some Bitcoin at Bitstamp. So that's, you figure the first in, first out at per place. But when you're using this cross-exchange infrastructure where you're buying Bitcoin at one exchange and then selling it at another exchange because it's going through this decentralized Ripple wallet, which isn't located anywhere. It's not in Hong Kong. It's not in Florida. There's no domiciled company that's where your assets are, right? It's a peer-to-peer wallet that has the order books built in. And so you have to get creative one way or another. I mean, we're all trying to figure out how to do our taxes. So all I know is that we have something to say if the IRS says, well, why didn't you calculate this way? It's like, because here's how we did do it. There's a precedent for it. Here's what makes the most sense given how we're thinking about the infrastructure. But yeah, that's definitely a huge issue.
And if it's in and out and you have a profit or a loss. And I did have a prior accountant who probably was not a Bitcoin expert, but he said from what he could see that, Bitcoin, yes, you have the profit, the loss, and all the rules are clear, but if you have some of these smaller coins that have almost no liquidity, he was fine if I treated it the way I would like a very small public or non-public company where it's just an illiquid asset until you sell it, and then when you sell it for Bitcoin, you declare that gain.
Right.
Because like if I had to declare like something like, what Mastercoin, I think the $70 a day of volume, I mean, so.
Right, and a lot of those coins don't have USD markets, so there isn't even a sort of a real clear way of how to figure out what its relative value is. I mean, if you sell Bitcoin for Catcoin for for Mastercoin, for Litecoin, and then somewhere way down the line it turns into dollars or Bitcoin again. It's almost impossible to figure out how to do that. Right, figure out what went in and figure out what went out. But even that's hard enough, because if it goes in one location and comes out another, you have to figure out where's the base.
Yeah. Awesome. All right, guys. Big hand for Dr. Joseph Salerno.
Thanks, guys.
Thank you, Joseph, for coming out.